Today, I'm going to be showing you the most powerful trading pattern you will ever see in the market. And I really mean that, no joke. This pattern shows up every single day. And if you can learn how to trade this pattern, you will be successful. So without wasting time, let's get to it. So the pattern I'm going to show you today is called the M and W formations. Other people call it the double top and double bottom, but I prefer to call it M and W formation. So we're going to be dealing with 4 subtopics here. Why do they form? How do they form? Where do they appear? And how to trade them. First of all, why do they form? Now, these patterns form basically due to manipulation by the big banks, smart money, or market makers. It's the market makers' intervention in the market. So their aim is to take your money, right? So they form these M and W structures or patterns in order to trick unsuspecting traders to take position and then reverse against them. Here we can see this is a beautiful M formation, and you can see right before news they form this structure to reverse the trend. They usually form these patterns at the end of a trend. So after they have been trending in one direction, let's say they've been trending up, then when they want to reverse the market, they usually form these patterns like the M formation in an uptrend. They will usually reverse and begin to form a downtrend. And to reverse a downtrend, they will usually use a W formation. So how do they form? Let me just give you an example here. How it basically forms is you have an uptrend, market is going up, right? I said the market has been going up for a while. Now, we know there are traders that buy the dip in an uptrend, right? So traders are buying here, traders are buying here and here because they are buying the dip. An uptrend consists of higher highs and higher lows. So as long as the market keeps forming higher lows, retail traders keep buying. So now to reverse this market, what do they have to do? What they do is on the last move, the last high that they're going to form, that move is usually very aggressive. Why is it aggressive? This aggressive move is to get traders rushing or panicking and entering this trade in here, right? So what they now do is we have traders who bought at this area and bought all over in this zone. What they usually do is they'll pull back maybe like 15 to 20 pips back down, hitting the stops of some weaker traders who didn't put their stop loss at the right place. Your stop loss is meant to be here, right? So the traders that entered late, they'll hit their stop loss. And then some traders who think this is about to reverse, who sold here, put their stop loss here, right? So what they usually do is they'll begin to consolidate for a while. After consolidating for a while, they'll move back up. What this will look like in the eyes of retail traders is this is another low, because remember they bought all the way here, they bought here, they bought here, they bought here. So now this is another opportunity for them to buy. We have retail traders buying here, expecting them to continue up to break this high and form another higher high. But what usually happens is they stop directly at the high. They fail to break that high. Once they fail to break that high, they'll form some candlestick patterns and reverse. Sometimes they'll throw a wick in there to hit the stop loss of the traders that sold here, trying to catch the reversal early, right? So they hit their stop loss, clear those ones out, also inducing traders to buy. Not only that, also hitting the buy stops of traders who put their buy stops here, so that if the market comes here to form a higher high, it will hit their buy stops and continue up, so they will wake up in profit or something like that, right? So they'll just throw a wick up there and then come back down, and then they'll reverse, hitting the stop loss of everyone that bought this uptrend, right? The only safe people are the ones who bought at the extreme low, but the other ones, they reverse to hit their stop losses. Also, when they form the M and W formation, when they form the formation, when they pull back like this, remember I said they'll usually consolidate for a while. This consolidation, what it does, we know consolidation in the market is not random. They usually do it to create liquidity. So now we have the consolidation here. They'll consolidate here, and then they'll break out of that consolidation, heading towards the highs, right? What does this do? We have an uptrend, right? You have people buying here. This is an opportunity to buy. Not only that, they form support and resistance, and then they break out of the resistance, which also causes more people to buy, to take this breakout, right? Heading to the highs to break this high and continue up, right? But what eventually happens is they reverse like this, and then they continue down, right? So that's how they form these M&W formations. Now let's move to where do they appear. Now this is very important. It's very important for you to know where they appear, because they don't appear everywhere in the charts. They appear at specific areas on the charts. So they usually appear at the high or the low of the day, week, month, or year. Those are the areas, those are the places they appear. That's where you see these formations. First of all, this line indicates the start of the day, and this indicates the end of the day. So this is one day, this is another day, this is another day, right? So each zone is a day, each box is a day, basically. One day, second day, third day, stuff like that, right? So this is the high of the day, right? And at this high of the day is the highest point. High of the day means this is the highest point of the day. And if you change this to a line chart, you can see that they form the M formation here to reverse. You can see that. Let's go on to another day. Let's see if they do the exact same thing. Okay, so this is the previous day. This is the high of the day here. And if you change this to a line chart, you can see a beautiful M formation here. Then they reversed. What did I tell you? You have an uptrend. This is a low. This is a higher low, higher high, higher high, higher low. So now this confirms that yes, this is an uptrend. So now this is meant to be a higher low for them to form a higher high. What did they do now? You see they pull back, and if you measure this, you will see this is about 10 pips. Okay, so this is the high of the day. Then they pull back and they begin to consolidate here like this. They begin to consolidate, forming resistance and forming support. Then they break out with this fat candle. Then they head back towards that high. They head back towards the high. You can see what they did at this high here. Look at what they did here. You see how they threw these wicks above the high, slightly above the high, slightly above the high, and then closing back below the first leg or below the high. And then from there, they reverse without looking back. There are traders taking this buy. There are traders buying here. There are traders buying here. And there are stop losses above this place where traders who sold in here are expecting the market to go down, and then they have their stop loss here, and then also buy stops up here for traders who expect this to continue up. So now they reverse the trend, and then they do the same thing to reverse the other way. You can see this is a very big W formation here to reverse. So if you were trading this pattern, you would have entered somewhere in here and caught this whole move in here like this. Alright, so that is where they form. That is where they appear. So how to trade them? So now we know why they form, we know how they form, we know where they appear. Now how do we trade them? Basically, there are several ways of trading this pattern. You have your M formation like this, right? This is the first half of the M. This is the first leg. You wait for the second leg, and when you see they fail to break this high, or maybe they throw a wick above that high and then they come back down, then you can enter this on a sell based on candlestick patterns, and then you can expect them to continue down. There are several ways of trading this pattern. You can also wait for them to break the neckline, and then for them to come back and retest this area and go down. Or you can trade this with an order block like this. So you have an order block here, and then they'll go back to this high and continue down like this, right? So you'll be basically, if you're trading the order blocks, you basically be entering here, your stop loss will be here, right? So that's how, there are several ways of trading this pattern. Just depends on how you want to trade it and the type of stop losses you want to enter with. If you're trading like this, your stop losses obviously will be larger. If you're trading at the second leg, your stop loss will be a little bit tighter. If you're trading with the order block, that will give you the tightest stop loss. And if you want to know how to trade order blocks and have sniper entries, click this video and it will explain just how you can trade order blocks, and I'll see you on the next one.